Okay, so today we're going to talk about valuation, and to get that started, let's think of a scenario here. Think of yourself as a consultant, and you've been asked to value a startup, and the startup has some financials, as I've shown here. And just assume that you've done your due diligence and you think that the numbers are good, that they can actually achieve these numbers. The team is good. The question at the end of the day is then, what is the startup worth? I'll give you a few seconds to think about that, and maybe pause the video to think, how would you figure out what the value of this startup would be? So today's discussion of valuation is focused on how to value a private firm. It's a bit different than public firms because the type of data available is not the same and the market's not the same. I'm going to teach you about 3 different approaches to valuing a business: the assets approach, the market approach, and the earnings approach, and I'm going to show you a couple different variations of each, just for your personal information. So the first approach is an asset approach based on the balance sheet. So the balance sheet records the assets of a company. And this approach is used, I'm kind of giving a larger view of private firm valuation, not just startups. This approach would be used for valuing a business that has been operating for a while, but for whatever reason needs to sell quickly. So this is kind of like the floor value of the firm. So if there were a divorce or the bankruptcy or the death of one of the owners of the business, this is basically just the value of the assets of the firm. So they're booked at a particular value on the balance sheet, but then they would be adjusted based on the market value of the assets, and then you'd subtract the liabilities, any loans that are paid, and then you'd get the value. So that's the floor value. If you own a business, you don't want to be selling your business for that price, but sometimes that happens. If you're buying a business, it's great if you can buy a business for the value of the assets or even lower. The next approach is the market approach. And this is an approach that you might be familiar with from your finance class as you've talked about stocks in the stock market. And basically it's based on the price to earnings ratio. But what's different about private company valuation is that you don't have a stock market. There are companies that gather data about sales of private companies, and they keep this information in a database, and so you can pay to access this database, and you can get the records of previous sales of similar type companies, and take the price and divide it by the earnings that were reported for that company, and then you have a PE ratio, and you can average those ratios, and then take that average times the earnings of the company that's being sold, and you get a price. So it's kind of similar to how you get a value for a house. You have comps, and you look at those comps and to see what the value of the house is. Similarly, you look at the comps for comparable businesses, find that price to earnings ratio, average it, and then multiply it by the earnings of the focal firm. So that's a market approach.